Hey everyone, this is Paul, re-recording this video for better audio in my darn good advice series of people using life insurance and selling it slash positioning it as if it were an investment. So let's just talk about life insurance real quick. It does have a place in your financial portfolio, and its role is very simple. Life insurance replaces lost income. So it should not be some type of investment vehicle. It is simply a way to replace your lost income. Insurance is insurance and investing is investing, and never the twain shall meet. The problem is, through this new thing called social media, they are able to reach a whole new and often younger and inexperienced market with marketing pitches where everything old becomes new again. These are the sales pitches for whole life, indexed universal life, and the latest great buzzword, infinite banking. Wow, you really got something there. And it's all about touting you with this idea of tax-free income forever. Now let's take a look and see the mechanics of what's actually happening for them to deliver on these very appealing sales pitches. So things are not always as they seem in insurance land. They're really not producing any kind of income. They're just doing a little bit of hocus pocus magic, and their idea of a tax-free or infinite income is simply borrowing from the cash value that they claim you're building up through their investments within your insurance policy. So you understand that? Your insurance policy is building up with investments something called cash value. They expect you to borrow from it, and they call that tax-free income. Maybe it is, since you don't really pay it back, but every time that you borrow, you reduce your death benefit. So if your family needed X amount of coverage, the more you borrow, the less you're protected. And they have slick ways of selling you more and more and more insurance throughout in order to keep you properly protected. The rate of return is a joke. It's subpar, and it's not applied to all that you're paying them each month. It's only applicable to what's left from your highly inflated premiums after fees, after additional commissions, and then, you know, they invest the rest. And they'll tell you through the slick sales guy, and remember, he is a sales guy. Very few certified financial planners will have you buying whole life policies. But they'll tell you that if you write the policy correctly, then we can get you all of the things that the detractors say that you give up. And I'll get into those things for sure. And then, of course, they'll say, oh, throughout your life, you build up this cash value that you can borrow against as needed, and you can borrow tax free. Well, all borrowed money is tax free. So you see, they're just giving you slick talk tracks to lure you in and help you seal the deal. So let's talk about how this very complicated thing called insurance with an investment actually works. So let's assume that you need a death benefit of $100,000. So you buy a $100,000 policy. You're paying in with premiums that are 5 times to 15 times, I'll rephrase, 500 to 1500 larger monthly premiums than the alternative, which is term insurance. And I'll explain term in a little bit. You get no growth or investing the first 3 years. How's that for an investment? Give us your money, give us lots of money, and you get nothing for 3 years. No, I'm going to say no to that. What they're really doing is they're buying a term policy that covers the $100,000 death benefit while you're building up a cash value. After they're done paying the sales guy his huge commissions, what's minus fees, what's minus commission gets put into a subpar investment idea, and it builds something called a cash value. From here, they want you to borrow and get that tax-free, infinite income forever income, which is really a loan. Now, every dollar you borrow actually reduces that $100,000 death benefit or face value. So the way they trick you into maintaining your insurance is that they keep doing something called a paid up addition. And all they're doing is taking more of your investment and buying more insurance, which is what they set out to do in the first place, was to keep selling you insurance. So now that you're borrowing $50,000 for a fishing boat, and if you die, your family only gets $50,000 of the face value plus a used $50,000 fishing boat. What they're doing now is they're making up for what you borrowed by selling you more and more insurance for a face value now that is higher than $100,000 that you started with. The other thing they'll tell you is, because when you die and one of these policies is in existence, your cash value actually gets surrendered to the insurance company. So you're building up an investment that for the first 3 years didn't build anything. And then you're building up a cash value that if you die, you get to give it to the insurance company. Ooh, how's that for a sales pitch? So again, what the slick sales guy will tell you is, well, if the policy is written correctly, you can get your cash value through what's called the fifth dividend option, which is simply another term insurance policy that covers the cash value. So they're going to claim that you're getting your cash value, but it's not really the cash value. It's just yet another insurance policy. So you can see that this gets very complicated. Like, so what happens when you die? Well, I touched on it earlier. You will get your death benefit minus any money that you've already borrowed. If you bought the fifth dividend option, you will get the value of your cash value, however small that may be. And if you didn't buy the fifth dividend option, then you simply get the face value minus any loans you've already taken out. And as I said, if you've been borrowing from this and getting your infinite income like they wanted you to do, because that's how they marketed this thing to you, well, then your family who needed $100,000 worth of coverage isn't properly accounted for unless you kept doing paid up additions, buying more and more and more insurance. Just ridiculous, absolutely ridiculous. So when you die, the cash value does go back to the insurance company. So they keep your money unless they've sold you even more insurance policies to cover what they're going to steal from you when you die. So this is like a true mess. So let's speak honestly about its alternative, which is term insurance. Now, term insurance operates just like your automobile insurance. First of all, it's a fraction of the cost, and you have life insurance for as long as you're paying your monthly premium. Makes sense, right? If you ever stop paying, your policy terminates and you're no longer covered. By the way, if you want to get out of a whole life, universal life, index universal life, infinite banking solution, there's actually even more fees called surrender fees, where they will now take even more of your money if you ever wake up to the fact that they've been ripping you off all along and you want to get out. So these things are an absolute disaster. But to their credit, one of the arguments that they will use is that your term insurance does get higher as you get older, as you get closer to dying, whereas your premiums, even though they're 5 to 15 times bigger, they will stay level until the policy is paid up, which means you've given them so much money that they no longer need to ask for money from you to cover you for insurance. But there is a point in our life where we will grow enough money on our own that we don't really need life insurance anymore. And in those outlying years when term insurance would be ridiculously cost prohibitive, you're never going to buy that insurance anyway. As a matter of fact, yet another footnote, about 85% of these whole life policies are cashed in and canceled before people die. So very few of them ever pay out. People get wise to what's going on and they cash out, they take their money and they go play ball somewhere else. But those arguing that term insurance becomes too expensive, that's really a straw man argument, because by the time you get old enough in life that you need to worry about the cost of term premiums, you won't need insurance anyway because you've become what we call self-insured. And also, I should state that when you buy term insurance, you can ask for something called level premiums. A 10-year, 15-year, 20-year level premium term means that you're going to pay the same rate every year for whatever the term is, 10, 20, 25 years. And what they've done is they've simply calculated your rate so that you're technically overpaying the first few years and then the costs catch up to you towards the back end. But you can, for the purpose of budgeting and knowing how much it's going to cost you, have level premium terms when you are doing term insurance instead of whole life. So let me show you the magic that happens when you buy term insurance instead of whole life. And do I mean take the $28 a month term policy and then blow your money on vacation? No. What I'm talking about is taking whatever the cost was going to be for these whole life infinite banking scams and using the same dollar amount, except now you're buying cheap, cheap, cheap term insurance and investing the difference. So we take a look here, your policy in whole life, index, universal life, whatever, is typically paid for 25 years. And if you look at these premiums, and I just made these numbers up, $3,600 a year for 25 years, and then you're paid up. If you would have taken that money instead of getting your investing through your insurance policy, you simply bought your term insurance and then invested on your own where you don't have to give back the cash value. Take a look at how some of these numbers go and notice that after 25 years, we stop giving the insurance company any money. The other thing I want to point out, because I did the 25 years of $3,600 to be on par with what you would probably pay into a whole life policy. But I want you to notice that around year number 9, the annual growth in the account is equal or greater than the $3,600 premiums that you were putting in. So there's actually only 1 decade until this thing starts to grow on its own. So therein lies one of the magic bullets, right? You now have a growth policy that truly after 10 years you could actually stop funding as compared to 25 years in a whole life policy because your annual growth number is now larger than your annual contribution. So this thing is like a snowball rolling down the hill all by itself, and it only gets bigger. How big? Well, let's go ahead and take a look. Their yearly growth number, which would be the equivalent to building up a cash value, grows larger every year, regardless of you contributing or not. Notice that when we start getting into year number 20 and your annual growth numbers are 18, 20, $23,000 a year, the 3,000 that you're putting in pales in comparison. And also notice that at year number 27, when your annual contribution in this graph goes to zero, this account continues to still grow by 40,000 plus a year and only gets bigger every year down to the point where you'd have $500,000 in 30 years and it's all yours. Mine, 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 mine. You don't have to give it to anybody. When you die, you don't surrender it like a cash value. And when they say, oh, well, you can borrow from this throughout your lifetime. Well, don't you think that if you had a $100,000, $200,000, $300,000 uh, brokerage account that you could make a withdrawal if you ever needed it for something? Of course you can. So why would you muddle yourselves in the complexities and fees and commissions of any of these ridiculous insurance policy scams? It's just not what I would recommend. So, what is the alternative? Well, we talked about it, and in the industry, it's called being a termite. You buy cheap term insurance and invest the difference. And I do want to emphasize that for this math to work, you do have to invest the difference. So remember that when you are a termite, you're paying 5 to 15 times lower premiums than the whole life alternative. You're investing the difference, which is the equivalent to making an investment inside an insurance policy, except now all of your money goes to work for you. It's not whatever's left of your money after commission, after fees in a subpar investment option. This is your investment choice, all of your money immediately available going to work for you. The cash value is basically yours. It's right. This is your brokerage account. You can use it whenever you want. You can just let it grow and pass it to your heirs as part of your estate. The rate of returns is significantly higher, even with indexed policies. You can outperform the earnings of a life insurance policy in your own brokerage account. And on the death benefit, you receive the death benefit of your term life policy, which is the whole purpose of buying the life insurance in the first place, but all of the cash that you built up in your brokerage account remains yours or your heirs without any need to surrender anything back to the insurance company. So you really won't need insurance at some point in your life because you'll be self-insured. You've made enough money that you really don't need the life insurance policy anymore, and you can simply not worry about the future cost of term premiums. So it does work out. So, folks, this was about 16 minutes of darn good advice on life insurance positioned as an investment. Now, clearly, from the way that I presented it, I am not a fan of this strategy or this product or even this industry as a whole. It's very deceptive and it's very misleading. And while the policies will do what they tell you it's doing, I reject the idea that they have to shroud it in so much gobbledygook, confusing talk, using a loan, calling it income, not paying back your loan, calling it tax free. It's just not there for me. And the fact that you can take a brokerage account as a termite and build substantially higher wealth than anything that you're going to grow in cash value, then it simply just blows away any argument that the insurance company or the insurance salesman makes about how you can borrow from it throughout your life and the money's always going to be available. Of course, it's your brokerage account. The money's always going to be available. And even if you were to factor in the long-term capital gains tax that you would be subject to on any money that you withdraw from your brokerage account, when you're earning 200% more, 300% more, 400% more, do you really worry about a 15% capital gain? I don't. So, that therein is where we are going to lay this issue to rest. Thank you so much for watching. Like and subscribe to my videos. Let me know if there's anything you want, and thank you so much from the Paul Napoli Financial Channel. I'm with you. See you in the next video.